Well, good morning. As I get this kicked off on Facebook, I'll let you guys know that Megan texted me this morning. She could not even call me, that she had, her throat was burning. She was sick. She is headed back to bed. But she wanted to make sure that we had a couple of tidbits from her real estate side as far as what's happening, and to let you know that we're absolutely going to be sending out not only the PowerPoint presentation for this economic piece, but then her reports will be coming out a little bit later today. So I'm really excited to be seeing you guys. I'm going to touch on four, I don't want to say issues, problems, hills that you've got to climb in order to communicate with your buyers and sellers. I'm going to get really knee deep on some tools that you can use as a buyer's agent and as a seller's agent to support your clients to get off the fence and into action, whatever that action is for them. But first, I'm going to start with a quote. We're going to jump into the presentation. Of course, for those of you that are just rolling in, Megan is not feeling well today. She is going to be sending out her report later this afternoon. She went back to bed and asked that we continue the show, make sure that we're talking about what's happening with the economics, because guys, tomorrow is Jackson Hole, and I'm going to show you on the charts what happened last time they were at Jackson Hole last year. You're not going to like what you're seeing. Then I'm going to show you what's happening in the economics really quickly with mortgage purchase applications, with durable goods, with PMI, things that you're going to want to know because we're starting to see some cracks. And then, of course, we're going to dive into some areas of opportunity around conversations and areas that your clients are getting stuck and how to unstick them. Super important right now, because I don't know if you saw, but rates hit a high since December 2000 earlier this week. They've come down a little bit. I'll tell you why that happened as well as we go into the weekend. So let's just start off. I'm going to share my presentation. We're going to jump into the economics. We're going to jump into those four hiccups that you're running into, those hills that you're having to climb with your clients. And then we're going to let you guys off early. Everyone wish Megan get well quickly. She's back in bed, but she will be sending out her report later this afternoon. All right, I'm going to share my screen and we're going to just jump into this. So let's start with our quote, because I tried to find something that I just love. Beyonce, I don't care what you think about her. It doesn't. So she said, I mean, because we're up against challenges. We're facing the hardships every single day. We talked about this last week. If you were able to join us in person at our Agenting Night and Market Update, that you don't have to go looking for your challenges. They literally are staring at you when you wake up in the morning. And I found this quote from Beyonce, and it just continues the theme. She's like, I'm going to keep running because a winner don't quit on themselves. Don't get lost in the challenges that we're facing every single day. Stay true to who you are, fight the battles, and continue to remain strong. Because depending on where rates go, depending on what the Fed does, depending on how fast the economy slows, and whether or not we enter into a recession, this could be a long winter. The last thing you want to do is give up, pull the blankets back over your head, and get back to bed. You want to continue to fight a good fight, because that's going to set you up for a phenomenal 2024. So if we jump into the market trends, I want to actually replay the quote from last week really quickly, because this is going to lead into the four things that we're going to dive into this week. So challenges are what make life interesting. Overcoming them is what makes life meaningful. And last week, if you joined us at Agent Ignite, we went through, or I did on the second half of our presentation, a full 30 minutes of first-time home buyer opportunities, whether it's down payment assistance, whether it's grants, whether it's 0 down loans, 3.5% down loans, or the Fannie Mae Freddie Mac AMI products. If you missed it and you want to watch it and you want to bone up on all the options that your first-time home buyer needs to know about, then that's in the Agent Ignite Facebook group. Super important, because as you know, there's a lot more first-time home buyers today than move-up buyers, because move-up buyers, well, they don't want to trade a home for a bigger monthly payment right now. So they're staying put. So you've got to be out working with those first-time home buyers. So last week, I took this quote and I zeroed in on down payment assistance, first-time home buyer options. This week, I want to take this quote plus Beyonce and really focus on the winners, right? What are those opportunities beyond the challenges? So are you dealing with a reluctance to give up low rates and move up from your sellers? Are you dealing with buyers who are waiting for rates to come down? Are you dealing with a hesitancy from buyers and a willingness to pay over ask when they find the right home because they keep waiting for the deal to happen? And do you have clients that are afraid of the bubble? They don't want to lose money. They don't want to buy now and expect home prices to drop down. We're going to break all four of those down, but let's jump into the market update really quickly first so that we know what's happening. And then at the end, I am going to, because Megan's not here, I am going to be jumping into if we have any questions and answer those. But as I said, we are going to get done long before our hour today. So, all right, some of the cracks. We've been watching a couple of leading indicators. Unemployment is one of them, and we're going to have the unemployment numbers next Friday for August. So we'll wait and see what happens with unemployment. Right now, it has been hovering at its lowest low. When it jumps up, we know that a recession is here. No recession, soft landing, certainly not getting a hard landing. So a lot of that is going to show whether or not it's cracks or whether it just keeps doing business as usual. But the one big leading indicator that we've been watching is this LEI, this leading economics indicator. So it's been negative for 16 months. Typically, it's negative for 6 to 9 months before we go into a recession. So to see this in negative territory for 16 months, this is really dragging out. A lot of it has to do with the fact that we have so much liquidity. People are still feeling good about spending. As we know, they've transferred that spending onto credit cards. We're still seeing strong retail sales. We're still seeing strong consumer confidence. And as that's happening, they're keeping this economy floating along and not going into a recession. But the LEI at 16 months is incredibly long and incredibly abnormal. The other leading indicator that we typically watch is this inversion, this rate inversion. We've been inverted for the last 15 months. And this is where the short-term interest rates and the long-term interest rates are inverted. If I loan you $100 for a month, I would expect to get a lower interest rate than if I loaned you $100 for 24 months. That's why the 30-year fixed is a higher interest rate than, say, a 10-year fixed. Well, that's not the case right now. It's inverted. And typically, when we see that inversion, we see a recession 15 months later. Here we are, 15 months later, and I'm not quite seeing it yet, although we are seeing a few cracks. Right now, the Wall Street Journal just came out with their headline saying that we're seeing weaker hiring. We talk about this all the time when we talk about the fact that when you see the jobs numbers come out, you see either the job stayers or the job changers, and the job changers have been getting a significant pay raise when they change jobs. That's not happening anymore. There aren't as many people or companies willing to pay in excess to pull those employees away from other companies. A lot of people are making do with technology, with efficiencies, and with keeping the employees that they have. In fact, initial jobless claims just came out this morning, and it was actually down at 10,000. That's not good. I don't want people to lose their jobs. But when we start seeing initial jobless claims increasing like we did a couple of weeks ago, then that starts to show us that there is some weakness in the job market and that we're going to see those lower wages. And with the lower wages, people aren't going to spend as much. And when spending goes down, consumer spending, consumer confidence goes down, then that means the GDP goes down. Because remember, consumer spending is 70% of the GDP. And when the GDP goes down, that means the economy is slowing, inflation slows, and then our interest rates come down. I hope that all made sense, because that's a pattern that you see repeated when we see recessions coming, which is why we've all been kind of silently rooting on a recession, because it means the economy is slowing and those interest rates are going to come back down again. Initial jobs claims went the wrong way. they went back down. There's some conversations that I'm reading online talking about the fact that we're hitting a pivotal point where we might see those go back up again, but really only time will tell. Durable goods fell. So that actually looked good for a hot second. It meant that the sale of durable goods, think washers and dryers, long-term appliances, cars, big ticket items, durable goods went down. But a lot of it had to do with airlines. So airlines, machinery, and equipment sales were way down because they'd been stocking up. In fact, like the month before, they were actually up. So that dropped down significantly. If I take those out, durable goods is actually staying consistent and it's hovering right above the zero line. So it looked good for a second and then it didn't. And then it was just like, okay, it's the airlines. Mortgage purchase applications are down for the 6th straight week. So we're seeing that they were actually down 30% year over year and down 5% week over week. We're feeling that. I know you guys are feeling that. Yet Megan did want me to, I asked her, I was like, okay, what are the big points from what you're going to show on your reports? And one of the things that she wanted to point out was the fact that we actually saw an uptick. So purchases were up almost 5% week over week. Odds of selling increased and days on market dropped 2 days to 12. We actually felt a pop of business as well this past weekend. We were very surprised. I've been talking to a number of different real estate agents, and a lot of them are saying either they had listings that went under contract or they had buyers get under contract this past weekend. Yet the front loading of mortgage purchase applications is down. So what does that mean? It just means that going into these winter months, we're not going to see as much activity. Existing home sales also came out, and Megan's report later today will show the existing home sales, the closed loans, the pending home sales, all of that data this afternoon on her reports. But the existing home sales nationally dropped 2.2% month over month, 17% year over year. The housing market, the existing housing market is certainly slowing nationwide. Yet the builders are taking advantage of this. They're taking advantage of the fact that they could pre-buy forward commitments and purchase interest rates at a lower rate. So a lot of people don't know exactly how a forward commitment works. And without going knee deep into this, I will say, so that you can actually prepay those mortgages, loans, and you buy them in buckets, and you prepay the discount. So it's not so much that they're getting a deal, they're paying for it. So if the current interest rate was 7.25%, but you wanted to buy down the interest rate to 6.75%, you might have to pay a point or 2 points in order to get that lower interest rate. The builder's doing the exact same thing. If the current market rate is 7.25%, and they want to offer 5.25%, they might have to pay as much as 7, 8, 9, 10 points to buy that rate down. Now, what they'll do is they'll buy $2 million to $10 million worth of mortgages, prepay those discount points in bulk, because remember, as an interested party, you can only give so much of a credit. So this is like, well, they're giving 10 points. You can't do that on a CD. But you can do that as a forward commitment. You can pre-buy this bucket of loans that you then resell to the end consumer who's purchasing your product. Those 4.99 rates, those 5.25 rates have gotten very expensive, and a lot of builders have run out of those money. So you're going to start to see if they do have forward commitments, they're going to be on the higher range than that. But new home sales hit 714,000 as an annual rate this last month. 655,000 is the historical average. So they're really taking advantage of the opportunity that they can do the forward commitments, and that home buyers are not finding the home that they want in the existing home sale market. Well, then the PMI numbers came out yesterday. So this is the manufacturing index, and this actually is global. So we saw the PMI indexes come out from overseas. First, it was Germany coming out in the middle of the night, our time, and they came out very low. So if you look at this, you have a number of countries who have all started moving into this contraction period. They've moved out of this expansion. So anything above 50 is an expansion. Anything below 50 is starting to be a contraction. So 3 of the main countries have moved into a contraction. The United States is still up here. We're still sitting in an expansion territory, but these 3 happened. And Germany happened overnight, and it sent our interest rates lower. So then all of a sudden we come out with our number, which was still better than contraction. It was still an expansion, but it was a little bit softer. And so it continued to show some softness in our markets yesterday. So if you were watching earlier this week, we had hit a high. So the 10-year treasury had hit the highest level since 2007, right? Now we bounced back down from that. You can see where that red line right there came back down again. We're at 4.2. We were at 4.43. That is significant. When we topped over 4.25 and then we hit 4.43, those are numbers that when you break above that for a period of time, that means that we're going to have a higher rates for longer. It's like breaking through a threshold. Then it's harder to get back down under the threshold. You have to break through it with some big news. So right now we hit up against it and we came back down with the PMI data. Interest rates did the same thing. They had hit their highest number since December 2000, and they came down just slightly. But I'll tell you, the really big news is coming tomorrow. I don't want to think that this is it, like the dumb is done. So, because we've been watching, and I've been telling you guys, every high has been higher. We've been trending higher, and it keeps breaking up closer to those ceilings. Well, now when we've got Jackson Hole tomorrow morning at 10 a.m. Eastern, so 8 a.m. here, and we'll be sending out the Friday text. If you're not on our Friday text, watch for the email that we'll send out after this presentation. You guys can sign up by texting yourself update to the number that we'll have in the email. But we're going to be talking about what happened at Jackson Hole, because the last time they met at Jackson Hole, it hit a run up. So they came out, Powell came out from Jackson Hole saying, this is when he said it, and for the first time, he said it several times after that, that we are going to have to cause pain. We're going to have to cause pain to households, and we're going to have to cause pain to business owners in order to control inflation. And he came out saying that, and we were already seeing a weakness in our interest rates, and he really set gasoline to the fire, and we saw a run up on our interest rates. So depending on what he says, if we're going to be higher for longer, if he says we're going to wait and see what the data says, if we're going to start to react, they pretty much said that they're not going to do anything as far as lowering the Fed rate until 2024. And now we're not expecting a Fed rate increase this next month, but we are thinking it might come in November, depending on how sticky inflation is. A lot of information is going to be coming out at tomorrow morning with that Jackson Hole conversation. So then let's jump over to the fact that for now, we're dealing with higher interest rates, higher home prices, a lack of inventory nationwide, still increasing prices. In fact, 4 of the 6 indices hit record home price appreciation, which blows my mind, because we had hit our highest and we dropped, and then we've started to recover from that starting in February. But nationwide, home prices are hitting yet another high. 4 out of the top 6 indices have hit recently new highs. So home prices hitting new highs, appreciation continuing to be strong, interest rates hurting and decreasing affordability, buyers scared and sellers staying put. So how do you work with this as an agent? How do you have conversations that are relevant without being too joyful? Like, you don't want to go, no, well, now's a great time to buy. And they're like, why? You want to be armed with the data so that you can respond accordingly and support that client getting off the fence and into action. And even if that action isn't today, even if that action is 6 months from now, a year from now, building your pipeline for 2024, continuing to support them in their decision-making. I want to support you with some documentation that we're going to be able to provide you on an as-needed basis, specific to your listing prices, specific to your buyer prices, so that you can be extremely relevant. So let's jump into this. So one of the biggest challenges, turning it into an opportunity, a reluctance to give up the current low rate and to move up. Now, I'm talking to a lot of clients about keeping that current home as a rental, pulling out equity, whether it's on a HELOC, a home equity line of credit, or a cash out refinance, and taking that money out tax-free and putting it into an investment opportunity, continuing to build wealth. Real estate is long-term. And remember, when interest rates do come down, we are going to see more demand coming into the market and pushing home prices even higher still. So that reluctance to give a low rate. I want to offer that there might be an opportunity in your database for a conversation around debt consolidation. Now, not everybody in your database is riddled with debt, but there are people in your database who could really use this information and they don't know yet, and you feel afraid to talk to them about it. But if you blast out to your database, or you're making calls every single day that says you might know somebody that needs to know this information, that even at 7% interest rate, there are opportunities to unpack the stress and the burden of consumer debt. Because remember, we're seeing less savings than we had historically. Now we're trying to climb back up again, but historically we had seen a 7 to 8% average savings rate. We're not quite above 5% yet. And then our debt is still high. We just hit 1 trillion in credit card debts. The unpaid balance is up 16%, meaning that cardholders are holding on to that debt longer. Average balances are $8,000 versus $4,000 per card a year ago, and delinquencies are up 50%. An average new car today costs $48,000 with a monthly payment of $1,000 with the interest rates that cars loans are at today. And HELOCs are at 9%, given the fact that prime rates are at 8.5. Having some of this information so that you can share that to say, if you know somebody who's in this position, they're not alone. A lot of America is sitting in debt that they don't know how to get out of. And if they don't have the resources to do that, and they're sitting on a home property that has a ton of equity, then we have options. In fact, the average loan to value for homes today is at its lowest ever. We're at 42% average loan to value. And remember, we've got almost 40% of homes don't even have a mortgage on them, but those homes that do, we're up to an average of 42%. I mean, look at this compared to previous years. There's a lot of equity that can be tapped into. So people are like, but I don't want to give up a 3% interest rate. Maybe you're thinking the same thing because you've got a home. And I'm talking to you as much as I'm talking to your clients. You're sitting and holding on and guarding that 3% interest rate. Meanwhile, you're drowning over here, whether it's in consumer debt or you're not taking advantage of the opportunities that you have today to get a deal, because deals are still being found. You're not taking advantage of an opportunity to get a deal, looking towards securing a better financial future while you're sitting here arming and guarding your 3%. And I get it, but it's short-term thinking. So if we've got this much equity, what I would ask the question is I get the fact that your home mortgage is 3%, but what is the rate of interest you're paying on all of your debt? What is the blended rate? And we can run the scenario for any one of your clients or you, or even just putting together a sample scenario for one of your newsletters or social blasts or emails. What is a blended rate? If I'm carrying all this debt, it's not 3%. Maybe it's 6%, 7%, 8%. And can I free up cash that takes advantage of an opportunity? In fact, my 2 oldest boys are under contract again on a deal that we found for $500,000. It could be flipped, but we're going to hold on to it and long-term rent it. And they're closing next Friday. There are deals to be had. And yes, their interest rate is not pretty. And I'm their mom and I got it for them. And I didn't love it either. But I'll tell you what, we got a great deal on a purchase. We have an opportunity to build long-term wealth and income opportunities. And I know with very high level of certainty that there will be an opportunity to refinance that interest rate into a lower rate and increase their cash flow even better. But you got to start out today not being underwater. It has to cash flow today. And those are harder to find. This happens to have a downstairs that we can rent out separately. So understanding what your blended rate is the first step to having those conversations. So debt consolidation is a massive, here, let's get the rest of this slide. Debt consolidation, when you're talking to a client, they might have a 3% interest rate. They might be moving up. Maybe they get a seller credit. They buy down the interest rate to 6.75. And you look at how much equity they have between their purchase and their loan and the cost to sell. What is that available equity? And yes, there are costs associated with purchasing it. If I go and buy If I sell today and I go buy that home that I really want, my monthly payment's going to jump up in this scenario, $2,500. I'm going to stop you right there. The answer is going to be no, because when you're talking to opportunities, when you're talking to wannabe sellers, they want to sell, they just feel trapped. They look at these numbers and go, I can't right now. I can't afford $2,500 more. What if your seller also has debt? I mean, that's a conversation you should be asking, and maybe they don't. And if they don't, and they're debt free and they're living a very fiscally sound lifestyle, then you got to go, man, I am so proud of what you're accomplishing. I can't wait to continue to support your financial journey through real estate. But I have an opportunity for somebody to take advantage of even today's higher interest rates, getting into a deal and consolidating debt and even moving them further ahead. And maybe you know somebody that would want to hear this. I'd love for you if you could pass on my information, right? There's no no in that. There's no no in that. You're building relationship, you're building communication, and you're building opportunity. So at $2,500 difference between my current payment and my new payment, I'm a no. But if I roll in, if I take some of that equity, because if I took all the equity from the old home and I put it in the new home, I'm going to be at a 64% loan to value. Instead, what if I took the excess equity and I went to an 80% loan to value? So I still don't have mortgage insurance, but I paid off all that debt and I removed the burden and I was able to move into my new home knowing that that payment was higher. I would actually only be within a couple of $100 of my overall debt load that I was having to be encumbered by every single month. That's the conversation. And maybe this is even positive. Maybe it actually swings in their favor. But knowing what that looks like is what gets you to that next conversation. All right, so let's jump into the next one. I'm waiting for rates to come down. Who's heard that? No one? Someone. I'm waiting for rates to go down. I hear that all the time. I'm going to wait for rates to come down. What does that look like? All right. So if I'm waiting for rates to come down, you got to talk about the opportunities. Remember, I just said 4 out of the 6 major indices is showing home price appreciation. Now, median prices and average prices are something different. It all depends on what homes are sold that month. But the home price appreciation is showing the growth of real estate in that market of that home, of that neighborhood, of that metro, of that state, and then nationally, home price index, HPI. So if I'm looking at waiting and I've got a higher interest rate, just having a cost of waiting spreadsheet is going to help me have a conversation with that buyer. So if I have a 7.25% interest rate today, if I wait 6 months and I really hope that after the first quarter next year, interest rates are going to drop down into the 6s, that's going to save me on my monthly payment. And it is 100%. Like, I can't deny that. If I wait a whole year and we see interest rates drop into the high 5s, that's going to save me on my monthly payment 100%. But while that's happening, my appreciation is going up. It's going up a little bit over the next 6 months, kind of flat maybe. Maybe it's going up more normalized. This is for Arapahoe County. The zip code that I plugged in is 80123, and we can plug in your zip code. And then what I see the appreciation is going to be, and this is based on an AVM model, what the appreciation expectation is for the next 2 years. And that turns into a cost. That appreciation, I've lost out on $10,000 of appreciation opportunity and principal reduction by waiting 6 months. I've lost out on the opportunity of $43,000 if I wait a year. I've lost out on the opportunity, and I don't even want to say it, of $83,000 if I wait 2 years. Make this real for your buyers. What is their cost of waiting? And yes, they're probably going to have to refinance, and there's a cost with that, but not if you use our Ruth Team rate drop assurance. So that's the certificate where we're going to pay all the lender fees and the appraisal if you come and refinance with us after purchasing. But that slight payment difference, if I remove that from the opportunity of the appreciation, the principal reduction, I still end up $7,400 ahead in 6 months. I still end up $39,000 ahead in a year, even if it costs me slightly more every single month in the monthly payment, and it costs me more a little bit to refinance. And I plugged in here only the title fees because I'm paying for the rest of it. I mean, come on. I believe in you and your clients and the dream of home ownership. And the Root team is putting our money where our mouth is. This is the content that you need to charge forward and have real conversations with your buyers and your sellers, helping them get off the fence. Stop worrying about the news and all the other stuff. Now, don't get me wrong. If it's not the right time for them, it's not the right time for them. But this is the information that they need to hear. Let's jump down to the third one. Hesitancy for buyers to pay over asking. Because interestingly enough, as the market seems, sorry about that. Interestingly enough, as the market seems like it's slowing down, we're also seeing some homes that are perfect homes in a perfect location and staged well are going for over asking. That's a really hard pill to swallow for a buyer. I can get deals, and this home over here has been sitting on the market for 2 months, yet that home, I got to pay $10,000 or $20,000 over asking. I'm not going to do it. But it's a perfect home for you. I'm not going to do it. Well, how do you bridge that gap for them? Because ultimately, what does that $10,000 mean? It means maybe $50 extra a month, right? Or maybe if it doesn't appraise, it means $10,000 over out of pocket. But what is the break even for that? So having the information to say, what is the current value based on when that seller originally bought the home, what they bought it for, what has the historic appreciation been for that zip code in that market? What is the home value today? What are they listing it at today? And what are you paying for over asking? And then based on that historical appreciation, what is the forecasted appreciation? So when will I break even? Again, I did the zip code 80123 based on a purchase price of $725,000. I have to go in with an offer of $10,000 over asking in order to win that bid. How quickly can I make that up? You can make that up in 5 months. People don't understand that, because right now it seems like I'm seeing prices drop across the metro. So prices are actually going down. The appreciation numbers are still going up. It's the fact that sellers are coming out too high. They're having to readjust to market and pull off some of that opportunity cost of the list price. They're having to pull off some of their desired appreciation and scale it back to what the real appreciation number has been over the last year. That kind of break even is massively valuable when you're talking to a client who's seeing this, and this home I have to bid over for, but these homes I don't. Well, buy those homes and put some money into them and fix them up and make them exactly what you want. All right, here's the fourth one, because I know I'm coming into my 30 minutes. So clients' fear of losing money. We are hitting a housing bubble. There are still conversations around that. Some key data points and some key charts that you can have in your back pocket is just a simple relationship between population increases and inventory shortages. Talking about the fact that this is absolutely 180% different than what we saw in 2008. When we had massive inventory, we just don't have it today. We have just around 1 million. And if you take out all of those pending home sales, it's much lower than that, just over 500,000. Yet the United States population continues to increase. And we know that that's going to continue because of birth rates for the next 20 years, or I should say, those kids who are 14 today and up are going to continue to be strong birth rates that are going to continue to push a demand on home prices. Plus the fact, and people don't think about this, just because you have high appreciation doesn't mean you're actually going to see a loss of appreciation. So we've seen this massive appreciation. I'm going to come back here. So we've seen this massive appreciation over the last couple of years. But if I go back, you see that in years, and it took decades to see a drop in home values. Again, everybody wants to focus on 2007 to 2011. We're just going to have a modest appreciation as we work our way back towards a normal historical appreciation average. Just because we had high appreciation doesn't mean we're going to lose value. That's part of what people are thinking. So having the conversations around demographics, about low inventory, about, yes, we're seeing new builds come in, but they can't solve for all the problems because as a percentage, there's just not enough of the inventory. The reduction of the inventory because of the rate lock, keeping sellers at bay, and then the higher interest rates giving buyers the opportunity today to negotiate opportunities. and having those conversations. So next Agent Ignite, Megan and I will be hosting it here at our office. We're going to be hyper-focused on credit repair. How are you setting up your buyers for success in 2024? So make sure to RSVP. Because it's in our office, we only hold 75 agents, so it will sell out. We will fill up. So make sure to reserve your spot early. We're going to be diving deep into how you can have conversations specifically with your clients to help them either debt consolidate or to improve their credit so they get a better interest rate and can afford more when they're ready to buy. Because if they're not ready today, they're not a no, they're just a not yet. That's the Roof Team motto. And we're putting our money where our mouth is, and we're paying back up to $600 of that credit repair. In fact, I just had a fabulous meeting with 3 agents yesterday morning, and they're like, well, we'll match that. If you do half, we'll do half, and we'll go up to $1,200 of credit repair. That puts somebody on up to a year's plan of putting them in a better position in buying real estate, because we so believe in real estate and the power that it gives families for financial stability and security. If you want to do that, I am all in, because that's what we believe. And the same goes with the strategy sessions. I have got my Calendly event or calendar, and we are booking out strategy sessions where real estate agents are bringing their buyer, and we're sitting down and I'm going through all of these. You don't have to remember all this. I'll go through it. I'll hit their objections with the data that they need to overcome that and get them off the fence. And even if it's a not yet, you know exactly what the objections are and what the results need to be in order to get that client moving into your pipeline. If you want to set up strategy sessions with each of your buyers, with you, your buyer, or your seller, and me, sitting down and talking through those objections, I am happy to do that. I have access to my Calendly, and I can send that to you, because together we are stronger than we are alone. And this is a war worth waging on. This is a war worth fighting for. This is the thing that we have to continue to be strong, that the power of real estate and what it does for the financial stability and security of our buyers is paramount, that they have this information, even if it's a not yet. It doesn't have to be a now, but continue to have those conversations with your buyers and sellers, teeing them up for next year, staying positive, staying informative, and staying in communication. That's how we all stay relevant, and that's how we get them to the finish line. I'm going to look at a couple of the Q&As. I kept you guys just a little bit longer than the 30 minutes, but this is so powerful, guys. So powerful. And remember, we're going to be sending out, Megan will be sending out her reports this afternoon. All right. So Arminio says, shouldn't we be seeing a slowing of some of the inflation when student loan payments resume in October, resulting in less discretionary income out there? 100%. 100%. Now, you've still got IBRs, income-based repayment plans, and you should be talking to all your clients about the new IBR program that's going into effect next July. They have to sign up for it now because it's a first come, first serve basis. Everybody will have access to it, but they're just going to process it in order of application. And so that IBR payments, those income-based repayment plan payments, are going to drop in half next July if they sign up for that new plan. But a lot of people still have zeros. A lot of people still have IBR payments. So will it affect? You've got to remember that there's a lot of people moving into the state of Colorado that either are paying with cash or have the ability to afford our higher home prices. Will we see an impact? 100%, just in time for fall and winter. Winter is coming. I have been saying that. And if that slowdown happens, and as we see spending slow down, and as we see the GDP slow down, and as we see inflation slow down, we'll see our interest rates slow down. But will we see it this year, or will it really come after the first quarter next year? There's a lot of data between here and there. I can't say for sure, but if it doesn't come in the beginning, it could hurt us in the spring as well and push back our initial buying season until a little bit later in the year. What do you know about sub-to transactions? Alan, I apologize. I don't even know what sub-to transactions is referring to, but if you want to elaborate on that, I'm happy to answer that question. Chris, what is the rule on rentals with a second home taking the tax deductions? The 6.331 blended rate isn't a big deal if you can take the deduction and have 2 properties instead of 1. So you're going to have the depreciation opportunity. So if I own a primary home and I take some of that equity and I go buy a new primary home and I convert that one into a rental, I am going to look at the whole blended rate by absorbing any of the credit cards or consumer debt, Obviously, you're going to keep that lower interest rate. We're either going to do a cash out refinance to pull out the equity, or we could look at a HELOC option. Remember, they're going to be around 9.5% right now. And then that new property. You are going to have tax deductions. You are also able to write off deductions from your primary home, depending on if you do itemized deductions or standard deductions. We can go all into that, and we can absolutely bring a CPA into that as well. So I don't know that I can't answer all the CPA questions. I'd like to think I'm pretty smart, but I'm not a CPA. All right. Alan, how were you able to find long-term rental for your kids with today's rates? What's your LTV? My LTV is 5% down. The boys did a 95% owner occupied. They're moving into it. It's got 3 bedrooms upstairs, 2 bedrooms downstairs, or at least it will when we're done refinishing it. They're going to live in one of the rooms, and then they're going to house hack the other rooms on their floor, and then they're going to rent out the other floor. So it barely breaks even with 5% down at today's interest rates. And that's house hacking and by the room rentals. But I'll take barely breaks even, because when they do move out and they're renting out all the rooms, it's going to even cash flow better. And when we refinance and drop them into a lower interest rate, it's going to cash flow even better. All right. Becca, where can I find the cost of waiting sheets for our clients? You just have to email me. Email me and we'll print them out based on your zip code, based on purchase prices. We can set up a template so that if you've got buyers in a general grouping, we can do a couple of them for you so that you've got these samples. And then if you've got any buyers that we're working with, we can send it for those specific buyers as well. All right, Babette, are you seeing more issues with properties coming in low on appraisals? I'm not. We have our own appraisal panel here with the Ruth team, and we've had some very good appraisals coming in. We are not seeing low appraisals on value very often. Sometimes with rental incomes, depending on what the market rent is, if somebody's pushing up their rents, we might see that be a little bit low if we need a rent comparison. But so far, the market is keeping it in check. Buyers aren't spending that much more like they were during the pandemic, where they were bidding $50,000 to $100,000 over asking. All right, and I understand we're not over our hour, but if you guys need to go, I'm going to keep answering these questions, making sure that I've got everything. So if you guys still have questions, I'm going to stick around and we're going to keep answering them. Patrick, with the bid over ask evaluation and the cost of waiting, those are made based on assumptions of what the market will do. And I know those assumptions are backed by data. But what if something changes and those assumptions are off? Do you let clients know that there's a chance? And if so, how do you set those expectations? That's a fantastic conversation, Patrick. I've been saying this for years. When people were coming out saying, marry the house, date the rate, I never liked that expression, because it sets you up with this expectation of time, that the rates were going to drop by this date. This is a race of an unknown length. We don't know. We had hoped that it was going to change last May. Then we hoped that it was going to change this fall. Now I hope that it's going to change Q1 2024. You have to set them up so that the payments equal the budget that they're willing to spend, that the appreciation works for their long-term goals. But you got to remember, a 6-month appreciation, a 1-year appreciation, a 2-year appreciation is very short term. I can go back to historical appreciation, go long-term appreciation. We know where it's going to go. As long as you're buying a home that's in a good area, meaning it's not on a highway. It doesn't have the parallel lines all over it. It doesn't back to a grocery store. I mean, you know those things when you walk up to the house. But if you're buying a home that's in a neighborhood that has consistently gained historical appreciation, it will consistently gain appreciation in the future. It just depends on how soft the appreciation is near term. But I'm not talking about, I just did a video on is it better to rent or to buy? And we're talking about the fact that sometimes short term, it's better for that person to rent if they know they're only going to be in that home for 3 to 5 years. Because right now, short term, I got a little softness and appreciation. But I'm talking about long-term opportunities. And the longer you wait, the longer it takes you to get started on building up that wealth. All right. Alexandra, this has been so good. Yay, I'm so glad. I do have a question more for the Megan side. Okay, and she'll be able to answer this. And I'll say this, do we have any numbers for how many sellers are providing concessions? She is absolutely going to have to answer that one. I don't have it. I can tell you from the Ruth team, the buyers that we're seeing, a lot of sellers are offering concessions unless our buyers are putting in an offer for either at list or over based on that home coming on the market that weekend. We are still seeing homes that go the first weekend are going for at or over, many of them anyway. And then the moment that they're on the market for past that weekend, they start to negotiate. So that's definitely something that she's going to be able to answer for us later though. All right. What are jumbo rates compared to conforming conventional rates right now? So jumbo rates are right about just under conventional. If you're putting less than 20% down, though, it is going to be higher. That is definitely seen as a risk in this financial market right now. But we are seeing the opportunity to get jumbos. And remember, we've got this, it's like a Venn diagram, right? So you got conventional, then you got high balance in the middle, and then you got jumbo. And many times, if somebody's inside that high balance price point, we'll often push them into the jumbo category so that we can get them a lower interest rate. So we're looking at all of those. Did he mean subject to? Oh, that was about the question that was before and I deleted it. So I'm going to have to, oh, okay. Alan asked the question again. So thank you. And that came from an anonymous. Chris, you're so awesome. I love you, Chris. Thank you for saying that. All right, Alan, here's that re-ask of the question. Subject to transactions, buyers are taking over the existing mortgage. What do you know about these transactions? So we have been seeing, it depends on what you're saying. If you're talking about an assumable loan, that's different than a wraparound mortgage. I've been hearing more conversations around a wraparound mortgage, and then you've got something called assumable mortgages. Assumable mortgages are only on Govy loans, VA, FHA, and USDA, when I can go in and assume that loan, take that interest rate, and I have to pay the difference between the purchase price and the loan balance, right? So as a buyer, I have to bring in the difference. Now, assumable loans have positives and negatives, and I can go into each one of them around USDA loans, VA loans, and FHA loans. I am not going to do that right now. I've had that conversation and I can have it again, but I know that we're going long already. That's assumable. Then you have these wraparounds where you're actually having somebody who owns that home, selling the home, the ownership rights of that home, but leaving the mortgage intact and allowing the new buyer to pay off that mortgage. That is going to cause you issues because that is what we did back in 2008, not me, but that is what buyers and sellers did that caused a lot of the issues or some of the issues that we saw when the mortgage meltdown happened. And Fannie Mae and Freddie Mac have since put in their guidelines that say, if you transfer the ownership from the person who has the loan, we will initiate a due on sale clause. So immediately we will call that note due the moment we see that the ownership has been transferred. The only exception to that is if you're transferring into an LLC and you are the owner of the LLC and you are also the lien holder. So that way I talk to a lot of investors about doing that. That's part of our whole investment strategy that we teach at Building Investment Empire. That was a lot and that was so good. And I miss Megan. You guys, we're going to be having the recording of this on our Agent Ignite Facebook group. If you want to record or rewind and watch any of this again, we'll have the copies of the slide deck. We'll be able to do all these tools for you specifically, your buyers, your sellers. We'll be sending out the email here shortly. Just respond back with any questions you have or any of those tools that you want to use. And watch for Megan's reports coming out this afternoon. And if you've got any questions specific to her about the concessions or other things, make sure that you email her right back and she'll be getting to those as quickly as she can, as quickly as she feels better. You guys have a great rest of your Thursday. Remember, Megan and I are both here to serve. We do this for you so that you can better advise your buyers and sellers. We ask in return that we have the opportunity to see your buyers and sellers at the closing table. Nicole Ruth, Megan Aller, we wish you guys a fabulous rest of your Thursday and this weekend. We'll talk to you soon.